What's up, y'all? What's up? Welcome back to another video with your boy Millionaire Abe. Shout out to everybody that's been plugging in, that's been hopping in all the free signals. I think right now, if I'm not mistaken, TP1 just smacked on Euro AUD. So if you're in the free signals chat, I know you caught that trade. I know you're probably, by the time you watch this video, you're probably like, bro, we already been smacked that TP. We on to the next. And if you're not part of the signals chat, make sure you go check it out in the description below. But for today's video, we are in episode 4 of the series of the Forex Sauce series. And today we're going to be going over, is it worth having an indicator on your screen? Is it not? Should I have an indicator? No. What's the pros and cons? What should I do if I don't want to use an indicator? Right? On today's video, I'm going to go over all that. So stay tuned. Let's get it. Alright, so in regards to using indicators versus indicators, me personally, I like switching between the two. Sometimes I'll mark my chart up first, and then I'll throw the indicators on when I'm debating on the move that I'm looking for. Some people like to just mark their chart up and just go based off of that, trading naked Forex and not using indicators and nothing. And then there are some people that simply only use indicators. They don't really mark their chart up. They just wait for the indicators to show them what the move is doing. If you're watching this video, if you're listening to this, I'll personally say, like, I recommend, like, it's really get both ways in your arsenal. So find out ways to where you can learn how to trade without using the chart, without using your indicator, and find out ways where you can trade with the indicator. But the best way to do it is when you can mark up your chart. You can have a blind eye like this, and your indicator is basically like more so like a confirmation instead of like your only way of knowing when you want to enter a trade. So let's say for example, like, hey, I'm looking for, I'm gonna take it back here. Let's say for example, I'm looking for a sale, right? The market is going for a sale. Okay, actually the market already having for a sale. Let me actually take it back even further than this. Let's cancel that. I like to do this because I could give you like a better example. Alright, cool. So let's say the market is getting ready to push up, and I'm like, you know what? Just off of looking at the chart alone, I got it. I got a pretty good understanding of what I think the market is going to do. It's going to go for a sell. So if you're an individual that's like, if you can trade price action, and price action is basically like you're looking for key levels and key areas where you see that there's a lot of volatility in the market, or that you're seeing that it's an area where there's major resistance, and you can see that, and you can just hop in for a sale like that, cool. If you're someone that's like, you know what, I need that extra confirmation, I need that extra step, that extra key thing that's going to let me know when do I need to get in this trade, when do I know when the correct time it is. Me personally, one of my favorite indicators that I've been using since the beginning of trading, I know some people will be like, ooh, that's trash. Some people don't like moving averages, some people do. Me personally, I like the moving averages. I feel like it's the most simplest strategy out there besides the Fibonacci. I know there could be confusing, other confusing strategies like Ichimoku, Bollinger Bands, what's another one? What's another trick on? I think those are the main ones that I know about. Off the top of my head I can think of, right? But I feel like the moving average is just simple. Like whatever direction that the lines are crossing, that's when you want to hop into a trade. So on a previous video before I started this series, I went over the moving averages. So I'm gonna go over it again on how I use it. Then from there you can like I ain't gonna go over like step by step. If you want that video, just go back to the moving average video that I actually have on the channel. But I will just go like over like a brief way of how I trade with the moving averages. So if you don't know what the moving averages are, they're basically like lines that I have specific parameters for mine. They're basically like lines that you use to tell you how the market is moving and when you want to enter the market. So my purple line is basically like the market. So when you're looking at the purple line, I call this the Kobe strategy. For those that don't know, call it the Kobe strategy because it's a sniper, just like Kobe when he used to shoot. And that's the reason I got the purple and yellow for Kobe. Purple, yellow, MA lines, right? Make your colors. So my purple line is the market. So when the market is going down, the purple line is going down. When the market is pulling back, the purple line is pulling back. When the market is going up, as you can see, the purple line is going up. It's going whatever direction that the market is going in, that purple line is going in that direction. Now my yellow line, excuse me, my yellow line is basically telling me when do I want to enter in. What direction in the market do I want to enter in? So if I'm looking for buys, whatever direction that my purple line is going in when my yellow line cross, I'm waiting for that cross. That's when I want to hop in for a buy. When I'm looking for sales, whatever direction that the purple line is going in when I'm looking for my sell, which is in the downtrend, my purple line needs to be going in the downtrend when the yellow line cross in order for me to look for a sell. So when the market is over here, and this is on a 1 hour, oh, this is actually on a 15 minute. So you can use this on a 15, the 1 hour, the 4 hour day chart. Obviously, the higher the time frame, the more you have to be patient with the move, because obviously sometimes the market got to set up for the play that you're actually looking for. You just got to be patient for it. So for currently on this video, I'm actually just on a 15-minute time frame. So when I press play, all I'm looking for, I say, hey, I'm looking for a sell to market. I see this is like a resistance area, potential head and shoulders setup. For those that know what a head and shoulders is, all I'm looking for, I'm waiting for my MAs to cross. Once they cross, I will hop into the trade. So even though I'm already knowing that, hey, I want to hop in for a sell, I could, just off the strength of price action, I could hop in for a sell now. But once those moving averages cross, that's an even better indicator. That's going to give me more confidence that this trade is now no longer just a 50-50 trade. It's a 70 out of, what, 30? Yeah, 70-30 trade. I have a 70% chance, 80% chance of having success on this trade just off of the confirmation with my indicator. So I'm going to try to start it. Alright, so my MA is crossed. I'm hopping in for a sell. Alright, so I was already thinking about getting the sell. I'm hopping in for a sell. My TP will probably be like anywhere between here and here. Alright, actually no, it'll probably be like, I probably look to go for like 30 pips. 30 pips at minimum is usually what I go to for TP1. So let's see if it gives us our TP1 pair. Let's see what we got. Let's see. Let's consolidate in right here. Boom, 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 boom. Alright, you taking your time. Speed. Man, GU be marinating, but once GU take off, it take off. That's the only downfall to it. It be taking all day. So as you can see, it's starting to push down. Alright, TP1 smash. Cool. About time. Alright, so TP1 smash. Once I waited for my indicator to tell me to hop in. Now, with that being said, the reason why I say, like, in the beginning I was like, hey, you want to have both a sauce to enter in before your indicator tell you, as well as when your indicator tell you. Because there's a lot of times, like, in the market where you might be waiting for your MAs. I'm going over and moving averages specifically, but there might be a time in the market where I might be waiting for my MAs to cross right here. But as you can see, I could have hopped in the sell up here, right? You see how much of a difference that is? Instead of you hopping in down here, waiting for the cross to hop in and only catching 19 pips, I could have caught the move back here at the top of the resistance and caught 36 pips, right? So that's the only downfall to indicators that I personally say. That's why I always recommend, I always tell people, all my students, like, you want to make sure that when you're trading indicators, you shouldn't have to depend on an indicator, but the indicator should just be like your extra checkpoint, your extra checklist when you're talking about, like, okay, your trading plan. What is my analysis to confirm that I want to hop in this trade? Or, like, what's the extra confidence that I need to hop in this trade, should I say? What's the extra confidence that I need to hop in this trade in order to guarantee that I'm going to receive profit, right? And then as you start familiarizing yourself with your specific pair, you will know, like, hey, you will actually know, like, hey, the market is doing this, I can hop in and sell here. And then it's gonna come a point, and that's where I'm at now. It's gonna come a point where I might hop on a sell. My blue line is my entry point for those that don't know. So I might have a sell up here, but once my MA is crossed again, I can hop in another sell. That's my confirmation candle. This is my confirmation candle. This is my confirmation indicator that the market is getting ready to go for a sell. And from there, not only can you catch 30 pips off of this pair, but you're gonna catch an additional 38 pips off another off the same move. So combining that 30 plus 38, that's 68 pips off of one move, just off of understanding price action without using the indicator, right? Just knowing based off of it alone, I know this resistance, I sell here, cool. Now that's my first entry. My second entry, cool. Off the move averages, off the specific indicator that I choose to use. Bet. Don't mind me, I'm just checking on the charts. Couple trades I sent out earlier. Alright, everything looking good. Bet. Alright, so back to GBP USD. Actually, GU is moving nicely too. I'm gonna actually delete this. So let me show you another example. I want to show you. I want to look for an example where, when an indicator might not actually. Let's see. All right, so this is an example. So I went over basically like how indicators can like get you in trades too late, right? But let's talk about like when an indicator gets you in the trade too early. And that's why it's important to identify where your major, like, not major, but where are your support and resistance levels 24/7 when you're actually trading. Because a lot of times, yes, your indicators might tell you to move, but who's to say the move is going to actually happen at that time? Right? Who's to say the move is actually going to happen at that time when the indicators actually cross? You got to pay attention to the time that the MAs are crossing. You got to pay attention to not only time when it's crossing, you gotta pay attention to like how volatile is the market today. Is it moving a lot? Is it moving slow? Because if it's moving slow, if you're entering around a time where the market is moving slow, you might get caught up in the let me go back to the 15. You might get caught up in a move that you weren't expecting to get into because you thought it was gonna move the direction that you wanted because the MA is crossed, right? So I'm trying to find a good one. All right, this is a good one right here. And then I'm gonna actually replay it right here. Replay, come on, let's get it. All right, so cool. So once again, we find ourselves GU, right? GBP/USD 15-minute time frame. When I'm using my indicators, right? Actually, without even using my indicators, we're gonna go back. So straight out the bat, the first thing I'm doing when I'm trading, I'm setting up my support, my resistance. Where are my zones? Where are areas that it broke out of? Where are areas that are rejected? Where are areas, the highest point and the lowest point? Those are like all the key things that I'm looking for. So where's the highest point in the market for the week or the day? Where's the highest point in the market, well, I said week or day, so both of those. So once I got those two, where are the zones that it's breaking out of? Where is the area that it's chilling at and consolidating? Once I have those areas, I know how to gauge it, right? So, and why do I keep messing up when I do that? Oh, trash, I can't even. I hate when I do it too early. I want to come further back so y'all can really see this move. All right, cool. So, the market is going in a downtrend, all right? But you see, this is the last buy, the last bullish area that the market was at before it go for a sell. I mean, before it went for the buy that it took out to all the way up here. So when it gets back to those certain areas, when it get back to those key levels, you want to make sure you're being cautious, right? You want to make sure, not only you want to make sure that first you want to look for that pullback, which you can see right here, right? But you also want to be cautious that the market isn't about to get ready to go for a reversal. So as you can see, when I press play, throw the MAs on it. So as you can see, when I press play, you're in a downtrend. It's starting to still go back down, right? But your MAs aren't crossing. So you're like, bro, like, should I hop in for a sell right here or should I hop in for a buy? Once you figure out, like, it comes a point to like where you understand, like, okay, you can either decide. The only reason why I say like you can either decide between taking this trade without the MAs versus not is like it really truly comes down to you knowing your pair. A pair like GU does a lot of break and retest. So really, once it breaks, you can 9 times out of 10 you can catch that retest, and you can catch that retest back to the zone that it attempted to break out of. And then like for GBP/USD, so like I said, it broke out here, right? You get one move right here. You missed the breakout, cool. You can buy for that reversal back to the zone that it broke out of. That's one trade. The next trade is going to be, usually once it retests, it's going to go back down for that sell again. That's that second entry that you could take. Now, 2 things are going to happen here. You're going to get a breakout down here, or you're going to get a stalemate. You're going to get a price floor. You're going to get that support level that's like, hey, you're going to come here, and you're not going to break this zone. Instead, you're going to start reversing for the buy. So, don't worry a lot of times. And basically, the moral story, what I was saying right there, if your MAs don't cross, be patient. Just wait for the setup, right? And I'm saying this specifically for MAs because it's like obviously the strategy that I'm using to teach y'all. But for any indicator in that matter, if your move isn't moving the right way that you wanted to, don't rush your setup. Just be patient, because a lot of times is you try to catch something, or you would think you see something, or like let's say for example these MAs start to push up and you try to be sweet. You're like, oh, I want to buy early because I see that my MAs are starting to push up and it's about to cross. Wrong. Wait until it actually crosses in order to buy. If it doesn't cross, you do not buy, right? Because if it doesn't cross with a sell, you do not sell, right? Because now I used to do that too. Like I used to try to hop in the trade early. I used to try to risk, not risk at all. I used to try to like get basically like you risking it, like you're betting that your MAs are gonna cross, and if the MAs don't cross, you're screwed, right? So in order to prevent that, how about we make sure that we're confirming that our MAs are crossing? So let's see what happens. Once, whoa, that was an accident. Let's see what happens once our MAs cross. Boom. MAs crossed. Not only did the MAs cross, but it broke back into the zone that it rejected here before. So if you don't know anything about candlestick patterns, usually once the market, this is a bullish and engulfing candle. So once that candle pushes above back into the previous zone that it just broke out of, that means it's about to get ready to start pushing back in the direction for the uptrend. So this is your first confirmation without even having indicators on your screen. So you should already see this before you even open up the indicators. Like, all right, bet, I'm thinking about hopping for the buy. Let me see what my moving averages are doing. Cool, they cross. Bet, I'm in there like swimmer. I'm hopping in for the buy. So my entry point is, let's say you hopped in here. You hopped in here at the blue line. And then what I tell y'all, I'm always, TP1 is always 30 pips for me. And then if you want to do it higher, that's on you. But me personally, I go for 30, 50, 80, 100, 150 on any currency pair, don't matter what it is. Right? So I'm gonna just press play. Let's see how this trade right out. Let's see. Bam. TP1. Let me make sure. I think that was a 30 pip one. Yeah, that was 30 pips. And then Daniel probably would have went for 50 pips. But this video is not gonna be too long. This video is like literally simple. Very simple. And I'm gonna show you the same thing going down. Cool. So it's very simple. Like, scratch the whole, oh, I don't use indicators, I'm better than you. Scratch the whole, I use indicators, I'm better than you. How about you combine both of them and get saucy with it? You see what happens when you don't use it. Cool. Just understand the candlestick pattern. Now you're just using your MAs as your confirmation. So you could have caught one entry right here once again, and then once it broke, you could have caught another one up top. Same principle. And then right here, as you can see what's going on in the market. Before my MAs even crossed, so I'm gonna hide it. Before any of this happened, right? What happened? It came back to that area that it started to sell. So what am I going to start doing? First of all, TP1 already smashed 30 pips. We out of the trade. Once the market start pushing up here, what am I looking for now? I'm starting to look for the sales in the market. I'm waiting once again for my MAs to cross, going back down for the sell. So let's see. So first of all, this candlestick and this wick actually shows, it actually means that the candle came all the way down here and then it started snapping back. So I'm like, okay, wait. Is this about to go in the uptrend still, or is this still going to go in the downtrend? Until my MA is crossed, though, I'm not going to take this trade. No MA cross, no entry. Boom. Your MA is crossed. We're back in there. Your entering rate, you probably enter around here after it already crossed. Right? Take that same trade back down. Anywhere between 30 to 50 pips. Let's see what we get. Oh, I forgot to say too. Okay, so on this trade specifically, stop loss obviously would have got hit. So stop loss is anywhere between 25 to 30 pips. Oh yeah, so we would have been out. We would have been out of there already. But once you understand, and actually, I can show y'all why. That's my beat. I'm just doing this based off of me just teaching y'all. Let's say if it's in consolidation or like in the zone or whatever it may have been. That's my beat why we hit stop loss. We hit stop loss on that because obviously, what is the trend in the market? It's an uptrend. So when it broke out, what do we think was gonna happen? Like once it broke out of this and started crossing the MAs again, should have just been in buys, right? So the moment right here, this is our first entry point. We caught our 30 pips. Once it pulled back and it found that this was the newfound support level, boom. I'm lucky giving y'all like kind of like some sauce right now. I hope y'all it's a little bit it's a little bit of both, indicator, no indicator, and just understanding like breakouts and candlesticks. So once we identify like, hey, it broke above this, hit 30 pips, cool. Once it pulled back and it did not close, actually these MAs didn't even cross. They ricochet. I hate when they do that. But yeah, that's exactly what I'm talking about. So, and actually I'm glad this happened. So that's another key thing. So if you're using the MA strategy, I know I said I wasn't gonna talk about it too much, but I'm gonna do it since I'm already on it. If your MAs cross, right here it doesn't look like it actually crossed. So that means I played myself and I caught out. But if your MAs cross for whatever move across, so let's say for example this cross for a sell right here. The moment that it crosses again in the other direction, close out of the trade. That means it's about to be a reversal in the market. I repeat, if your MAs cross for a sell right here, cool. You roll this way down, perfect. The moment it crosses again, going for a buy, get out of that trade. Do not take the trade no more. That means your trade is over. The market is losing the momentum in the market, and you're about to get ready to like get in for like a storm if you actually try to hold that move, because you're trying to be greedy in the market. Don't be greedy. Take your profits and dip. So I'm gonna go ahead actually. Where is this? I can't find it right now, but we're gonna actually just get rid of that. All right, there we go. Delete. I don't like my chart to be too messy. All right, bet. So once they cross right here for a sell, cool. I'm in profit for a little bit, but once they cross again, bite that bullet. You're only down like you. Honestly, you probably would have broke even if you would have entered for a sell right here, and then it came back to your entry point, close. Like you would have broke even, so it wouldn't even be no profit. It would have been no problem no matter what. But the moment that they cross again, close that trade and look for the buy, because obviously it's about to get ready to go back in the uptrend. And then you would have lost 10 pips, and then you could have caught that extra 30 going back up. 30, 40, go crazy. But I'm gonna end this video short. But I just wanted to show y'all like the power of like using indicators to your advantage after like basically understanding like how to analyze a chart without using the indicators. Indicators are there to support you, but don't let it control like when you actually happen to trade, because there are times where the indicators can be delayed. So it's up to you to realize like, hey, like you really like study like how the candlesticks are actually moving, so you can analyze and understand when is the time that you want to hop in. And whenever, for me, like what I do is once I catch myself uncomfortable, like once I catch myself like, hey, you know what, I'm not that confident on this trade, like it's moving too slow for me or it's not acting right, I will just simply wait for the MAs. And that's the safest thing that you could do, because I mean you're going to be securing your trades. You're going to be more like aware and understanding like, you know what, I'm going to be disciplined on this trade. Like the fact that I don't feel comfortable with this trade, I'm not that confident with it, let me actually wait for my MAs. Let me actually wait for the move to come. So thank you for those that stayed to the end of this video to watch episode 4. Yep, episode 4 of the series. And I'm going to catch y'all episode 5. Episode 5, I'm coming different. I'm coming different for episode 5. Episode 5 will actually be, I'm tripping. This is not even episode 4. This is episode 3. I got confused because I dropped the markup video. I'm so sorry for that. Wow, I really just got confused. Wow, I'm tripping. So yeah, episode 4, we're about to get away from the charts, but we're about to actually switch over to going over risk management. How to actually, what's the proper lot sizes you should be using for your accounts. How much should you place on each trade that you take, and everything in that nature into taking your account, excuse me, from $100 to $1,000, $100 to $2,000, $3,000, $4,000, to however much you want to grow your account to. So stay tuned for the next video. I'll holler at y'all until then. Peace out.